Good evening, dear students. Good evening, everyone.
Good evening, sir.
Good evening. So, in the last session, we had completed the cost of capital. Now, it's time for us today to begin with a new topic, which is capital structure, guys. So, you have to start with a new topic, which is going to be the capital structure. So, let's understand what do we mean by capital structure first. And then we will discuss about how do we deal with optimizing the capital structure, what are the various theoretical aspects to it. Okay, now when we talk of capital structure, what do we really mean by that? When we say the word capital structure, what do we really mean by that? That's simple. Capital structure means we are talking of proportion. We're simply talking of proportion of debt, equity, proportion of debt, equity, and preference shares. So capital structure is simply, we're going to talk of proportion of debt, equity, and preference share. Right. So in the capital of company. Okay. Now, if I ask you, out of these three, which is debt, equity, and preference share, out of these three, which is debt, equity, and preference share, which one do you think is the cheapest source of capital? Which one is the cheapest source of capital, guys? Yeah. Equity? No, it's not equity, guys. The cheapest source of capital is debt. Debt is the cheapest source. So debt is going to be the cheapest source of capital because debenture holders are not taking any risk. Debenture holders do not have any sort of risk in their funds. Rather, the risk, they do have risk, but then the risk quantum is substantially lower when you look at the equity. So debt is the cheapest source of capital, but that doesn't mean, can we have a company with 100% debt? Can we have a company with 100% debt? No, right? Right. So we cannot have a company which has got only debt. I mean, there's just no equity, only debt. We actually can't have a company like that. So rather, we would like to know, what should be the amount of equity and the amount of debt that we should be having in our capital structure. Okay. So that is how we are going to decide. Right. So the question is, how do we decide? The question stands here is, how do we decide? Right. So we are looking at the point that we want to decide. How do we decide what should be the proportion of debt equity? So how are we going to decide what should be the proportion of debt and equity, guys? How do we decide that? So the rule is, you will try to maximize, you will choose that proportion which is going to maximize earnings per share. And if P is given, if price to earning ratio is given, then we are going to look at the point of where we are going to maximize MPS. Right, guys? So this is how we are going to take a decision with regards to how to choose a particular financing plan. Okay. So financing plan, recognize. Yeah. So out of the available financing plans, we will choose the one where we find that the EPS is maximum. Where we find that the EPS is maximum, and if obviously the PE is given, then we look at the uh, the plan which is having the highest MPS. Okay. Now, so let's just take an example to understand this particular aspect. Let us say let us say funds requirement. Suppose the amount of funds that we need, funds required is, let's say, 25 lakh. Now, being a company, you can obviously raise funds from multiple sources. Now, let us say we're looking at three options to raise funds. So, option 1, option 2, and option 3. So, we have like equity shares, which is, let's say, we can raise the entire money of 25 lakh by way of equity shares in option 1, right? Second option is to raise, let's say, 15 lakh by way of equity shares. Okay. And debentures, let's say, having an interest cost of 10%. So debentures are, let's say, issued to the tune of 10 lakhs. This is the second option. Third option is to raise equity shares by 10 lakh, debentures at 10 lakh, and preference shares. Preference shares at the rate of, let's say, 12% to the tune of 5 lakhs. So, of course, the total capital employed that we have is over here 25 lakh, 25 lakh in the second case, and also in the third case, 25 lakhs, right? Now, let us say earnings before interest and tax is 5 lakh in any of these situations. Okay. So, okay, face value are of, let's say, 10 rupee. Okay. Face value is 10 rupee of the equity shares, right? And EBIT is going to be like 5 lakh, because wherever you raise money, by whatever source you're going to raise the money, that doesn't matter actually, right? Because whatever money we are raising from multiple sources, right? Whatever money we are raising from multiple sources, we are, getting it in total 25 lakh, and that 25 lakh is invested into the business, right? 25 lakh is invested into the business. By investing 25 lakh into the business, you can get a earnings before interest and tax to be 5 lakh. You can get the earnings before interest and tax to be 5 lakhs. Okay. So earnings before interest and tax is 5 lakhs. So with this EBIT of 5 lakh, we want to know which of these plans is best. So first we will subtract interest. which will give us PBT. Then we will subtract the tax. Let's say tax is at the rate of 30%. Okay. And then we get the figure of profit after tax. Further, we will subtract the preference dividend, which will give us net profit for equity shareholders. And of course, we are going to divide this by number of equity shares, which will provide us earnings per share. Okay. So can you complete this income statement and all the three plans and suggest which plan is to be selected based on, of course, the highest NPS criteria? Based on the highest NPS criteria, can you select which one should we be really choosing based on the highest EPS? Can you calculate the EPS in each of the plans, guys? Yeah. Can you calculate EPS in each of these plans? Yes. So just calculate the EPS, guys. Calculate the EPS numbers, guys. Give me the EPS numbers of all the three plans. Yeah, guys. Find per share. Yes, you have to find EPS, earnings per share, correct? So the interest, in first case, it should be 0. In case of second plan, it will be 1 lakh because that's 10 lakh into 10%. And then third case, also it is 1 lakh. Right? And the PBT stands as 5 lakh, 4 lakh, and 4 lakh. tax will be at the rate of 30%. So we have like 1,50,000 as tax and 1,20,000 being the tax in the third case. PAT is 3,50,000 and here it is 3,80,000. Sorry, it's 2,80,000. Right, and here also it is 2,80,000. So preference dividend, there's no preference dividend in the first two plans, but we have it in the last plan, which is 60,000. So we have the net profit for equity shareholders, 3,50,000, 2,80,000, and 2,20,000. Number of equity shares in option 1, it is 2,50,000. In option 2, it is 1,50,000, and in third option, it is 1 lakh shares. So the EPS numbers are like 1.4, 1.87. Of course, plan 3, option 3 is the best one, right? Right, so option 3 is the best one, where we're getting the EPS is the highest figure. So of course, we should raise money by way of option 3, which is a combination of equity, debt, and preference share, right? So if these are the EPS, we calculate the P numbers first. So price to earning ratio. So price to earning ratio, we have, let's say the P ratio that's given to us. P ratio is, let's say, 13, 12, and 10. So we can calculate the market price per share as earnings per share into P ratio. So let's say I'm giving you the P ratio. I'm providing you with the P ratio of 13, 12, and 10. So market price per share is going to be EPS into P ratio, which is 1.4 into 13. That's 18.2. In the second case, that's 22.4. And this is going to be 22. So MPS is going to be EPS into P ratio, which is 18.2, 22.4, and 22. Okay. So that's your MPS. MPS is 18.2, 22.4, and 22 guys, right? Now, based on this MPS criteria, we can definitely choose second plan for raising funds. Right? We can definitely raise second plan, use the second plan for raising funds for the business. Make sense, guys? Yep. Very good, everyone. Clear? Okay. So that's how you choose the particular plan for deciding. You choose a particular plan for raising of money, which will lead to maximum market price per share, guys. Okay, so let's have a look at this question number 2. Question number 2. Just read this question 2, guys. I'll be sharing this file on the portal after today's lecture. Look at this question 2. Just read it. Okay, so the existing capital structure of XYZ Limited is as under. So equity shares of rupees 100 each, 40 lakhs, retained earnings of 10 lakh, 9% preference shares 25 lakh, 7% debentures 25 lakh. The existing rate of return on company's capital is 12% and the income tax rate is 50%. The company requires a sum of 25 lakh to finance its expansion program, for which it is considering the following alternatives. Issue of 20,000 equity shares at a premium of rupees 25 per share, issue of 10% preference shares, and issue of 8% debentures. Okay, so these are the what we say, three items that we are having. I mean, three ways by which we can raise the funds. So we've got three plans. So first, let's talk of what's happening with the current numbers, and then we'll talk of the plans. So we have current plan, plan 1, plan 2, and the third plan. So we have over here equity share capital, then we have got the retained earnings, equity share capital, retained earnings, 9% preference shares, and 7% debentures. Okay, so these are like the existing capital that we have. So current capital is having a equity share capital of 40 lakhs, retained earnings of 10 lakh, 9% preference shares 25 lakhs, 7% debentures 25 lakhs. So in total, as of now, we have total capital employed of 1 crore. How much funds are we looking to raise in addition? We are looking to raise 25 lakh, guys. We're looking to raise this 25 lakh to finance our expansion program. So you're looking to raise 25 lakh, and we've got three options. So of course, when you go to plan 1 or plan 2 or plan 3, I need to consider it in cumulative basis. So in plan 1, we are raising money by way of 20,000 equity shares at a premium of rupees 25 each. So debentures of 25 lakh. That's going to continue as it is, right? But the equity share capital and the retained earnings are going to change. Shares of 20,000 equity shares at a premium of 25. So since 20,000 shares are issued, the share capital over here, right? So I'll just do the working over here. Share capital over here will be originally 40 lakh plus 20,000 shares of rupees 100 each. So this is going to be like, share capital is going to be 60 lakh. Right, guys? So 60 lakh is the share capital. And then the reserves portion, the reserves, it was originally 10 lakh. But since we are issuing shares at a premium of 25, that premium will be coming to our retained earnings, right? So 20,000 into 25. So 10 lakh plus 5 lakh, which is going to be 15 lakh. Okay, so retained earnings is 15 lakhs. Of course, the total is now going to be, total capital employed is 1 crore 25 lakhs. Now the second plan that we have, guys, second plan is by way of 10% preference shares. 10% preference shares. So share capital, it will be originally 40 lakhs as it is. Retained earnings 10 lakh. 9% preference shares will continue to be 25 lakh. 7% debentures will continue to be 25 lakhs. But 10% preference shares will also come over here now, worth 25 lakhs. And then we have the total as 1 crore 25 lakhs. Now the third plan is to issue debentures of 25 lakhs, and debentures are having an interest cost of 8%. So 8% debentures. So plan 2 is equity share capital 40 lakh. Retained earnings will be 10 lakh. This is 25 lakh. 7% debentures of 25 lakh. No preference share over here. But we have debentures costing 8% in the third plan, and the total capital employed is 1 crore 25 lakhs. Okay. Okay, so this is what we got. And then further they say it is estimated that price earning ratio. Okay, the P ratio is given, and which one would be considered the best. Now, to calculate which one, subtract the tax to arrive at PAT. Further, we subtract the preference dividend. Then we get the net profit, divide this by number of equity shares, which will give you EPS. Further, EPS will be multiplied by P ratio to arrive at NPS. Okay, so it ranges from EBIT till NPS. Now, the best part over here, I need to look at the other part is, how do we really calculate, the EBIT? So for that, we need to look at what is return on capital employed. What is the return on capital employed? Return on capital employed is, of course, calculated as EBIT upon total capital employed. Now, originally, we had a EBIT of how much number, guys? In fact, the existing rate of return is 12%. It's given to us. It's going to be like 12%. It's already given to us. So we can calculate EBIT for each of these plans. For each of these plans, we can calculate the EBIT, guys. Okay, so each of these plans, we can calculate the EBIT. EBIT is going to be at the rate of 12%. So I can say expected EBIT will be 1 crore 25 lakh into 12%. So 1 crore 25 lakhs into 12%. How much is it? One crore 25 lakh into 12% is going to be 15 lakhs, right? So we start with EBIT of 15 lakhs for each of the plans. So you choose any of the plan, 1, 2, or 3. The earnings before interest and taxes 15 lakhs. Now the market price per share. Yes. Yes, guys. Correct. Okay. So let's start. I'll just give you one more idea over here regarding the P ratio. Remember, the P ratio is 20, 17, and 16. So P in the first plan is 20, second plan 17, and this is going to be 16. Okay. 20, 17, and 16. These are the P ratios. I think you should be able to calculate the NPS now. Just complete this question, guys, quickly. So, interest is 1,75,000 in the first two plans, but in the plan 3 it is 3,75,000. PBT is 13,25,000, and in plan 2 it is 13,25,000. Plan 3 it is 11,25,000. Tax rate at the rate of 50%. This is 5,12,500. Here we have 6,62,500. Sorry, this is 6,62,500, and in plan 3 it is going to be 5,62,500. PAT is 6,62,500. Plan 2 again it is 6,62,500. This is 5,62,500. Preference dividend is 2,25,000. Okay. So we have the net proceeds, net, what do we say, the net profit as in first case it is 4,37,500. Okay. Sorry, there's no preference dividend. There's going to be preference dividend of, this is going to be 4,75,000. Yeah. So this is 4,37,500. This is 1,87,500, and finally it is 3,37,500. Number of equity shares is going to be, in first plan it is 60,000, second and third plan it is going to be 40,000 each. So this is 60,000, and here it is 40,000, and here it is 40,000. So we get the EPS numbers. EPS is what? Net profit divided by the number of equity shares. So this is 7.29. Then we have 4.69 and 8.44. So you multiply EPS with P numbers, 7.29 into 20, which is 145.83. Then we have 79.69, and this is 135. So of course the best plan is the first one, which is giving us a market price per share of 145. Getting it, everyone? Are you all getting this? 145.83. Yep. Cool. Yeah, we got it. Perfect. So then let's take up another question on the similar lines. Okay, let's try out this question 3. Question number 3. Would you like to solve it? Question number 3. Would you like to attempt it, guys? Question number 3. Will you attempt it? Yeah. Okay, just go ahead. Okay. So did we get it? We've got two plans over here, right, guys? We've got two plans. First plan is by raising debt, and the second plan is by issuing equity shares. Look at question 3 solution. So we have we'll plan 2. Then we have equity share capital. Equity share capital is, in the current plan, we have the equity share capital to be what? 40,000 of rupees 10 each. So equity share capital is 4 lakh, right? Then we have the reserves. In the current plan, reserves are, I think reserves are given, undistributed reserves of 6 lakh, yes. So reserves of 6 lakh. Then debentures. Debentures at the rate of 12%. It is, of course, 60,000 since it's the interest. So 60,000 divided by 12%. That's going to be 5 lakh. So debentures are 5 lakh. So we have the total capital employed as of now as 15 lakhs. Now the plan that we have, first plan is by way of issuing debt. So new debt is something that we are going to issue. So in plan 1, we have the equity share capital, or let's say plan 1 is what? Additional funds are raised by debt, right? So when it is raised by debt, your equity share capital will continue to be 4 lakh. Reserves will continue to be 6 lakh. The older debt at 12% will continue at 5 lakh. And a new debt is being raised to the tune of 2 lakh. Now, what will be the rate of interest on this debt? Because this is going to be like 17 lakh. So how do we determine the rate of interest that will be applicable on this debt? So the question says that we have to look for the debt equity ratio, which is debt upon debt plus equity. If this particular ratio is higher than 35%, P ratio will be 8 and the new interest will be 14%. So let's just try to check what's the debt to equity ratio, or what's the debt to debt plus equity. So debt to debt plus equity is going to be 7 out of 17, right? So 7 out of 17. 7 out of 17, that's going to be what? 41.18%, guys. And this 41.18% is greater than 35%. So therefore, the new debt is going to cost us 14%. And the P ratio is going to be 8, guys. Now let's look at the second plan. So in the second plan, we are going to issue equity shares. Of course, equity shares will be issued at the current market price. Current market price is 25. So the new equity shares, the number of equity shares that will be issued, will be like, 4 lakh plus 2 lakh divided by 25 being the share price, right? 25 being the share price into 10 being the face value, right? So first we'll need to check for new equity shares to be issued. Is like number of new equity shares to be issued. Number of new equity shares to be issued, that will be like 2 lakh issued at a price of 25. So 2 lakh equity shares issued at a price of 25. That's going to be 2 lakh divided by 25. That's going to be what? 8,000. 8,000 being the number of equity shares. So this is going to be 4 lakh So the new capital is going to be like 4 lakh plus 8,000 into 10. So the new share capital will be 4 lakh 80,000. Now reserves is simply going to be the original reserve value of 6 lakh plus 8,000 shares into 15 each. So this is now going to be what? 7 lakh 20,000. Debentures, older debentures of 15 lakh will continue. And this is going to be what? 17 lakh. Here the debt to equity ratio is 5 upon 17, which is 29.41%, guys. Suppose it's less than 35%. So your P ratio will be 10. So price to earning ratio is going to be 10, guys. Now, before we go ahead with the EPS calculation, I need to check what's the return on capital employed. Return on capital employed. Return on capital employed will be EBIT. What's the EBIT in the question? Let's have a look at it. EBIT. So we can see that profit is what? This is 2 lakh 60. So our return on capital employed is 2 lakh 60,000 divided by 15 lakhs. 2 lakh 60,000 divided by 15 lakhs. And this is going to be 2 lakh 60,000 divided by 15 lakh is 17.33%. So return on capital employed is going to be 17.33%. And I'm going to apply this return on capital employed to arrive at EBIT. So in the plan 1, our EBIT, or rather I'll say, originally it is 2 lakh 60,000. In this case, it is going to be 17 lakhs into 17.33%. So EBIT is 2 lakh 94,667, right? This is also 2 lakh 94,667. Then we subtract the interest. Then we get the PBT. Further, we subtract the tax, which will give us the PAT. This divided by number of equity shares will give us EPS. And then we just multiply it by P ratio to arrive at MPS. So EBIT is 2 lakh 60. Interest in the first case is going to be 5 lakh into 12%, which is 60,000. In the second case, guys, interest will be this 60,000, which is 5 lakh into 12%, also 2 lakh into 14%. 2 lakh into 14% is 28,000, right? So 28,000 plus 60,000, that will be 88,000. And interest in the third plan is going to be 60,000 itself. So we get the profit before tax as 2 lakh. Then the second plan is 2 lakh 6,667. Then we have 2 lakh 34,667. We subtract the tax. Now tax will be subtracted at the rate of what? What's the tax rate over here? 50%, guys. So 50% being the tax. Over here 1 lakh. Then second it is going to be 117,333. And this is 1,03,333. Then this is 1,17,333. So we have the PAT figure as 1 lakh, 1,03,333, 1,17,333. Number of equity shares. We can say number of equity shares is in the originally thing, it is 40,000. Right, so this is 40,000. This is also 40,000. And this one, sorry, over here it is going to be, yeah, this is going to be 40,000. And since the equity shares are issued over here, we'll take it as 48,000. So earnings per share stands as 2.5 in the first case, 2.44 in the second case, 2.58 in the third case. Price to earning ratio is 10, 8, and 10. So market price is 25, 24.44, and 20.67. Okay. So out of these three plans, should we go to plan 1 or plan 2? How 2.94 lakh arrived? You can see 17 lakh being the capital employed. Kuldeep, 17 lakh is the capital employed. On that, our capital, return is 17.33%. Okay, so should we go for raising new funds? Should we go it for new plan? Of course, both the plans are going to result in reduction of your NPS. So rather, we should stick to our original current plan itself and need not issue any new sort of capital, because that new capital that we have, the new capital that we have, it's not going to add any additional benefits for us. Okay, fine. So this is the solution to question number 3. You can just copy the solution. Okay, guys. And after that, you can just take a break of 15 minutes. We'll be back by 7:25. Yeah, 7:25. Okay, so let's take a break, guys. After break, we'll continue with some more concepts on this capital structure. we can go for the next concept, which is called as the financial break-even point. Okay. Let's first talk of something called as break-even point, guys. What do you understand by the word break-even point? What do you mean by break-even point, guys? Yep. What do you understand by the word break-even point? Anyone? What is break-even point? Okay. No profit, no loss. Okay. So no profit, no loss. Okay. So understand that break-even point is the sales level. Break-even point is the sales level at which there is no profit, no loss. There is no profit, no loss. Perfect. Now, if I ask you something like financial break-even point. Okay. Financial break-even point is we're not talking of the sales as such over here now when you want to calculate the break-even point. Financial break-even point is level of EBIT at which EPS is equal to 0. Right? So financial break-even point is that level of EBIT at which EPS is equal to 0. So financial break-even point is that level of EBIT at which EPS is going to be equal to 0, guys. So let's try to understand this in a better way. Suppose we have capital structure of a company wherein we have, let's say, equity share capital, debentures, and preference share capital. So equity share capital is 10 lakh, debentures is 5 lakh, and preference share capital is also 5 lakh. Debentures are costing us 10%, preference shares are costing us, let's say, 12%. Now, let me just give you some exercise. We have EBIT. From that, we subtract interest, so we get the PBT. Further, we subtract the tax, so we get profit after tax. Then further, we subtract the preference dividend, which gives us net profit. Divide this by number of equity shares, which gives us EPS. Now, one thing we know is that EPS is to be 0. So I just want you to calculate now, basically a reverse calculation over here. Okay. From EPS, you have to arrive at EBIT. So if suppose we want the EPS to be 0, what should be this level of EBIT? Of course, I can write down the amount of interest to be 50,000 and amount of preference dividend to be 60,000. So can you just do the reverse calculation and arrive at that EBIT which can give us the EPS of 0? Just think of it. Just do the reverse calculation, guys. Try to give it a shot. Do the reverse calculation and arrive at EBIT, guys. Do a reverse calculation and arrive at EBIT. Tax rate, take tax rate as 30% only, guys. Let's say tax rate is 30%. Let's do the reverse calculation and arrive at the EBIT level. Anyone is able to calculate it? Okay. Let me do the calculation. So here doesn't matter what's the number of equity shares is, your net profit is definitely going to be 0 for that. And since our net profit is 0, the PAT has to be sufficient to cover the preference dividend, right? Of course, if PAT is to be computed as 60,000, we know PBT is 100, so tax is 30, PAT is going to be 70. We can just do the reverse calculation. The cross multiplication part, in which we just multiply 60 with 100 and divide it by 70. So multiply 60 with 100. So 60 multiplied by 100 divided by 70. That's going to be what? 85,714. 85,714. And then adding it back, it becomes like 135,714. 135,714. That's your EBIT, right? And this 135,714 is what we call it as the financial break-even point. Now the question is, do we need to really do this, reverse calculation every time, or is it possible for us to have some shortcut? Definitely, we have got a shortcut, guys. So financial break-even point can be calculated as interest plus preference dividend upon 1 minus T. interest upon preference dividend upon 1 minus t. So this is essentially interest, which is 50,000 plus preference dividend of 60,000 divided by 1 minus 0.3. So 50,000 plus 60,000 divided by 1 minus 0.3. So this works out to be what? 60,000 divided by 0.7 plus 50,000. As you can see, 135,714. This is the way to calculate the financial break-even point. Good. Okay, once we have computed the financial break-even point, let's try to understand what's the significance of it. What is the significance of financial break-even point? What is it, that's so cool or so intuitive about the financial break-even point? Listen, guys. Let's say we have got 3 plans. And we compute their financial break-even point. Plan 1, financial break-even point is 0. Second plan is having a financial break-even point of 10,000. Third plan is having a financial break-even point of, let's say, 36,000. So out of these 3 plans, which plan do you think, guys, is challenging to be profitable? Which of these 3 plans do you think is going to be making the things challenging for you to make your business profitable? Where can you say that, rather, I would like to put it other way around. Where can you say that you can turn your business profitable in an easy manner? Which of these 3 plans, if you follow which of these 3 plans are likely to provide you a better, which of these 3 plans are likely to provide you with a better way to deal with the profits? Where can you attain your profit easily? When can you become profitable in a quicker manner? When can you become profitable? Of course, in plan 1, right? Because since the plan 1 break-even point is 0, so the moment you have some amount of EBIT, you start making profit. Whereas in plan 2, we can say until EBIT is greater than 10,000, EPS will be negative. And in plan 3, we can say until EBIT is greater than 36,000, EPS will be negative. Right, guys? So unless and until we see the EBIT crossing that break-even point, we won't be able to make our business profitable. So if you want our business to be profitable or a positive EPS, we should be obviously crossing the level of break-even point, which is EBIT should be exceeding the break-even point. Right, guys? Perfect. Yeah. So obviously, if I ask you which plan is having the highest or which plan is having the lowest risk, what would be your answer? Which plan do you think is having the highest risk and which plan is having the lowest risk, guys? Tell me. Which plan is having the highest risk? Which plan is having the lowest risk? Which plan is having the highest risk? So Over here, this is the highest. There you have like a moderate risk, and this is having a lower risk. Okay. Okay, guys. Correct. So financial break-even point is going to be a deciding factor as to which plan is having the highest risk, which plan is having the lowest risk, right? So of course, when you want to decide about choice of plan, you're going to choose the one which is having the lowest risk, right? Now, let us understand something called as an indifference point now. Indifference point. Indifference point, it is the level of EBIT. It is the level of EBIT at which EPS of both plans are equal. It is a level of EBIT at which EPS of both plans are going to be equal, guys. So indifference point is that level of EBIT at which EPS of both plans are going to be equal. So let us say we have two plans, plan 1 and plan 2. We don't know what is their EBIT. Let us name them as X. Less interest. Suppose plan 1 is having an interest of 10,000. Plan 2 is having an interest of 30,000. Then we get the PBT figures, right? Then we're going to subtract the tax. You get the PAT figure. Further subtracting, let's say, the preference dividend. So preference dividend over here is 18,000. And then you get the net profit for equity shareholders. There's no preference dividend over here. Net profit for equity shareholders is divided by number of equity shares. So number of equity shares over here, it is 4,000. And here we have this as 4,500. And then we get the EPS. So I want you to calculate this X so that when you reach up to this level to calculate EPS of both plans should be equal. Can you calculate the level of EBIT at which EPS of both plans are equal? Yeah. Just think of it and try to calculate the EPS, guys. Just think of it and try to calculate EPS. I mean, the level of EBIT, which is at X, which will make EPS of both the plans to be equal. Yeah. Just give it a try. Tax rate, again, the same. You can consider it to be 30%. Yeah. Just try to form the equation and get the value of EPS, guys. Okay. Let me just put up this in the form of an equation. So let's say we want to calculate EPS of plan 1. EPS of plan 1 will be your EBIT X minus 10,000. So of course this X minus 10,000 is representing the PBT figure. Now to make it a after tax figure, which is post tax PAT, I just simply multiply it by 1 minus 0.3, which is the tax rate. And then further subtract the preference dividend of 18,000. And then this divided by number of shares, which is 4,000. Then EPS of the second plan, guys. This is going to be X minus 30,000, making it post tax 1 minus 0.3 divided by 4,500. Because there's no preference dividend that's going to be subtracted. So net profit for equity shares is going to be same as this figure. And we have now the relation as EPS 1 and EPS 2. I can definitely equate both of them. X minus 10,000 into 0.7 minus 18,000 divided by 4,000 is equal to X minus 30,000 into 0.7 upon 4,500. Okay, so X minus 10,000 into 0.7 minus 18,000 upon 4,000. Other side, it's going to be X minus 30,000 into 0.7 upon 4,500. Can you just equate both and get the value of X, guys? Equate both of them and get the value of X. Just equate both of them and get the value of X, guys. Equate both of them and get the value of X. We can simply subtract this double zeros from this side. So this has 0.7x minus 7,000 minus 18,000 upon 40 is equal to 0.7x minus 21,000 upon 45. I can actually reduce it further, right? So 8 5 8s and 5 9s. Do the cross multiplication. So 9 into 0.7x minus 25,000. And this is what? 8 into 0.7x minus 21,000. Just open up the bracket. So 9 into 0.7, that will be 6.3x minus 25,000 into 9, which will be 2,25,000 is equal to 8 into 0.7, which will be 5.6x minus 21,000 into 8 will be 1,68,000. Let's bring x on one side. So we have 6.3x minus 5.6x is equal to 2,25,000 minus 1,68,000. So 6.3 minus 5.6, that's 0.7x is equal to 2,25,000 minus 1,68,000. That will be 32 plus 25, which is 57,000. Yeah. 25,000 plus 32, yeah. 57,000. And then we get the x value as 57,000 divided by 0.7. So 57,000 divided by 0.7, which is 81,429. 81,429. That's the value of x, guys. Did we get it? Yeah. Yep. Everyone? 81,429. That's the what we call as the plan one, which is the that's the indifference point, guys. 81,429. So if I just take this entire table again, what are we getting here? This is like 81,429. So 81,429. You can just calculate it fully and give me the value of EPS, guys. Calculate it and give me the value of EPS for both the plans. Ideally, they should be same, but just we are trying to check. Get the value of EPS, guys. Get the value of EPS. What's the EPS? So it's 8. So earnings per share is 8 in both cases, right? EPS is going to be 8 in both the cases, everyone. Earnings per share is 8 in both cases. Right? Okay. So now, what's the significance of this indifference point, guys? Just listen. The significance of indifference point. If EBIT is less than indifference point, then plan with low risk will be preferred. And if your EBIT is greater than indifference point, then we can say plan with high risk will be preferred. So if your EBIT is less than indifference point, plan with low risk will be preferred. And if EBIT is greater than indifference point, plan with a high risk will be preferred. So if your EBIT is less than indifference point, the plan which is having a lesser amount of risk is going to be preferred. Now, if I ask you, like over here, out of plan 1 and plan 2, which plan is more risky? What will be your answer, guys? Which plan is more risky, guys, in this case? Out of these two, which one do you feel is having a greater amount of risk? Which one do you think is having a greater amount of risk, guys? Yeah? Which one do you think is having a greater amount of risk? Same risk? No. How do we know which plan is more risky or less risky? We calculate the financial break-even point. So let us compute the financial break-even point of plan 1. Financial break-even point of plan 1 is interest of 10,000 plus preference dividend of 18,000 divided by 1 minus 0.3. So that's 10,000 plus 18,000 divided by 0.7.
यार लाइब्रेरी तो
So
बंद हो गई होगी ना
18,000
आई
divided
नीड
by
मोर फॉर माय
0.7.
रिसर्च
दीदी आपको पता है ना आपके पास गूगल जेमिनाई है
Got a mad over here. Just a moment, guys. Let me just take some time to close
यार
it.
ये जेमिनाई तो बड़े काम का है
Press to learn with Google Gemini. Try now.
So it's 18,000 divided by 0.7, which is 25,715. So financial break-even point is 35,715. And financial break-even point of the second plan. Financial break-even point of the second plan. It's just the interest. Which is essentially only the interest of 30,000. The financial break-even point is 35,715 and financial break-even plan of second is 30,000. So both of them, we can see second plan is having a 30,000, second plan is having a financial break-even point of 30,000. So this is obviously having a low risk and this is having a high risk. So now I can definitely say if EBIT is greater than the indifference, which is 81,429, plan 2 will be preferred. And if your EBIT is less than 81,429, then plan 1 will be preferred. Okay. Okay, guys. So EBIT is going to be determining which plan is going to be preferred. So if it is a high risk plan, right? High risk plan, then high EBIT is required to justify that plan. Okay. Fine. So let us do some questions on this. Okay. We have this question number. Yeah, question number 6, guys. Just give it a try. Question number 6. Question 6. Try to solve question number 6. You have to determine which is the financial break-even point. Okay, so Hypothetical Limited is in need of 1 lakh to finance its increasing net working capital. The finance manager of a company believes that its various financial costs and share price will be unaffected by the selection of a particular plan since a small sum is involved. Debentures will cost 10%, preference shares 11%, and equity shares can be sold for rupees 25 per share. Tax rate is 35%. So, financial plans, there are three financial plans, guys. First is equity shares, second is some amount of equity, preferential, and debenture, and third is again a combination of equity, preferential, and debenture. So, let's first write down the capital structure, guys. Let's first write down the capital structure. Capital structure. So, we have plan 1, plan 2, and plan 3. Equity share capital, preference share, and debentures. So, equity share capital is fully 1 lakh in the first plan. Then equity share capital over here, it is 30. Preference share, it is 10,000. Debenture, it is 60,000. Okay, preference share debentures are going to cost us what? 10%. Preference shares are going to cost us 11%. Okay. Okay, one more thing. Equity shares can be sold for rupees 25. They're saying equity shares can be sold for rupees 25. Suppose this is going to be what? Equity share capital, and also we need to have the reserves, guys. We need to have the reserves. So equity share capital will be, 1 lakh. 1 lakh divided by 25, which is 4,000, and share capital is 40,000. Reserves is 60,000. Second plan is 33 lakhs, so it's going to be like 30,000 divided by 25 into 10, which is 12,000 will be the equity share capital, and reserves is going to be 18,000. And in the last case, it is 50, 20, 30. So it's going to be what? 50,000 divided by 25 into 10,000, which is 20,000, guys. 20,000, 30,000, and then we have 20,000 and 30,000. So total capital employed is obviously 1 lakh. Okay. Total capital employed is 1 lakh. So total capital employed is 1 lakh. Now here we can say the amount of interest, it is 0, here it is 6,000, here it is 3,000. Preference dividend is 0, 1,100 and 2,200. Right guys, that's your preference dividend. Now we can get the financial break-even point. Obviously, first case financial break-even point is 0. Right guys? And here it's going to be what? 6,000 plus 1,100 divided by, what's the tax rate? 35%. So 1 minus 0.35. And then this is 3,000 plus 2,200 divided by 1 minus 0.35. So 1,100 divided by 0.65 plus 6,000. So we have 7,692 as the break-even point. And here we have 2,200 divided by 0.65 plus 3,000, which is 6,385. These are your financial break-even points. So these are the financial break-even points. And then which plan is having a greater risk? Which plan is having a greater risk? Out of these 3 plans, can you tell me which plan is having a greater risk, guys? Which of these 3 plans do you feel is having a greater risk? Obviously, the plan which is having a higher break-even point, right? So this is the plan, which is the second plan, which is having a greater risk. Now, why do we say it's having a greater risk? Because the financial break-even point is higher in this case. Got it, everyone? Yeah. Great. Now, try out this question number 9, guys. Try question number 9. Try out question number 9, guys. Try this question number 9. Just give it a try. Question 9, guys. Okay, so there are two alternatives: 100% equity finance. So we have to calculate the indifference point. So for first plan, we have EBIT. There's no interest, and the tax rate is 40%. So 1 minus 0.4 upon the number of shares is going to be capital outlay 60 lakhs. So number of shares will be 6 lakh. On the other side, it is going to be funded by debt and equity. So it's going to be X minus interest. Interest is going to be 2. So interest is essentially going to be 60 lakh into 2 by 3. That's the amount of debt. On that, you're paying an interest of 18%. And then we take it as 1 minus 0.4 upon share capital of 60 lakh into those 40 lakh is issued as equity, and rest, of course, it's going to be 2 lakh, right? It's 2 lakh. Corporate tax rate is issuing price. Okay, so we can calculate the indifference point. This is going to be what? 0.4x upon 6 lakh is equal to, sorry, 0.4, this is 0.6. 0.6x minus 60 lakh into 2 by 3 into 2 divided by 3 into 18%. It is 7,20,000. That's multiplied by 0.6, which is 4,32,000. Right, upon 2 lakh. So we can definitely cancel out this, and this is also just 3. So 0.6x is equal to 3 going on the other side, 1.8x minus 4,32,000. 4,32,000 into 3, which is 12,96,000. Right, so we can take 1.8x on the other side. So we have 1.2x is equal to 12,96,000. So we have the value of x as 12,96,000 divided by 1.2. 12,96,000 divided by 1.2, which is 10,80,000. This is the indifference point, yes, 10,80,000. Okay, fine. So with that, we are done with the first part of capital structure discussion, guys. Right, first part with the capital structure discussion. We have one more point of discussion, which we will be definitely taking up in the upcoming session. So till that time, enjoy, guys. See you in the next class. Bye bye and take care. Good night, guys. Okay, guys. Bye bye. Take care, guys. See you.